Guys, welcome to Newbie Real Estate Investors Podcast Live, episode 7. We got a special treat for you guys today. We have 3 new guests on the panel today. And first, we have Gilbert. We got Mike Dunn and Abdel. So why don't I start off with Abdel first? Abdel, if you don't mind to introduce yourself to the audience, let them know what you do, what's your background. Yeah.
Awesome. So, well, first of all, thanks for having us. I appreciate it.
Get a little closer to the mic.
Yep.
Yeah.
So,
thanks.
first off, thanks for having us. I appreciate it. So, again, my name is Abdel Kawatmi, involved in the mortgage end of this business. I own and operate a mortgage and pre-licensing school called Got Originator, and then also own and operate as a branch manager, Paramount Residential Mortgage Group called the Got Mortgages team. We're based out of Eatontown, New Jersey, which is around the Long Branch down the shore.
Yeah, it's a
A little bit of a drive, I know.
Yeah.
I grew up in this neck of woods in South Hackensack, so luckily I knew my way around. And right when I hit the traffic, I was like, "Yep, I'm in North Jersey." But yeah, that's a little bit about me. Born and raised in Jersey, love it. We do lend throughout the entire nation, so I do have a couple satellite branches in California, Florida, Pennsylvania. But Jersey's the bread and butter of the HQ. So
Nice. And Mike?
Yeah, Mike Dunn, eXp Realty. And thanks for having me, Joey. Appreciate it.
Of course.
I am a full-time realtor, also an investor and a former general contractor. I've been licensed. I got my real estate license about 8 years ago. I got it initially because I had this construction company and I'm flipping houses, and I really wasn't impressed with the caliber of the agents that I was encountering out there in the world. And I thought to myself, I think I could do this better.
yeah,
Turns out I like this side of the business a lot more than I like babysitting 26 carpenters and working on Mrs. Smith's kitchen. So I was also in the restoration business. I owned a mold remediation, water damage, fire damage company, so I know everything there is to know about that stuff. And I did very well for a long time, and I got exhausted by that. That's a very, very difficult business. So for me, as challenging as selling residential real estate can be, it's such a breath of fresh air to what I used to deal with. So I love it. I've been a full-time agent now since, I guess about 4 years ago. I joined eXp and I went full-time. And I bought and sold a couple of construction companies, and I'm out of that business now. I do, as you know, I manage some construction projects here and there. I did a few kitchens last year for clients.
Yeah. Well, we worked on one together.
Yeah. So, here and there I'll get my hands into a construction project, but really my focus is listings primarily. Very selective about working with a buyer, but I will work with buyers from time to time. Yeah. So that's it. I cover all of North Jersey. I'm based here in Bergen County. I've been in Bergen County for like 25 years.
Nice.
So, yeah.
And last but not least, Gilbert.
Last but not least, I've been listening to quite lengthy resumes. Mine is not so long. So I'm in real estate, got into real estate during COVID. So it's been a baptism of fire. So working in residential and commercial real estate. Prior to that, I was 25 years in finance and transportation. So it's been, as I said, working residential and commercial, trying to find my way in the business, working with buyers, trying to get the listings.
It's tough.
Building my business, and that's where I am at the moment. Still building.
Cool.
Yeah.
Nice.
Thank
So
you for inviting me to be here.
yeah, of course. So I guess I'll introduce myself as well for some of the newer audience that don't know who I am. I've been a general contractor also for about 20 plus years. I own this place, Kitchen Design Lab. We opened the doors around 2019 over here. So kitchen cabinets, countertops, anything from rental property to high-end residential, like $5 million homes. We do those as well. Anything. We have 8 lines of cabinets, so, something to fit everybody, right? And, I also flip homes as well as an investor. And I've been doing that since I did my first, it's not really a house flip, but it's more of a rental back in 2008. And I started really like flipping homes in 2017, and also own a rental portfolio as well. So right now in New Jersey, we own about, I want to say about 40 units in New Jersey. And then out of state, through real estate syndication, we own a little over 600 units outside. So, that's, I guess for me, that's what kind of gives me the qualification to, and talk to the audience, right? So we all have kind of diverse backgrounds, which is awesome. So we can kind of run things by each other, sure. Right? And let's kind of get into the show. And then back there we have Joe Falla. I want to shout him out as well, and Gherald, what is that called? The clapper guy?
The clapper.
Yeah. So, thanks a lot, for helping us put together the show. So we do this every Tuesday at 2 p.m. Without fail. So this is our 7th show. Before that, we had about 60 plus episodes, and they were more geared towards real estate investors and interviewing real estate investors. So, and it was just kind of like a one-on-one or two-on-one interview, and kind of dives deep into the realtor or investor themselves, and kind of like what kind of strategy, why are they unique compared to, everyone else in the industry, right? What their background is, kind of what they do in terms of the work they're doing, So, yeah. So let's kind of get into the show itself, right? Let's talk about interest rates a little bit, right? Because we were talking about that earlier. Well, I wasn't, you guys were. And let's dive into that a little bit, because people want to know what's going on with the interest rates. Where are we today with it? And where do you think, as a prediction, where do you think it's headed?
Yeah. Well, I guess I'm taking that question.
Yeah.
The guy wearing mortgages on his shirt. But so, I mean, starting it off, right? So today is July 18th, right? Just because it is, when I say literally day to day, it is as day to day, sometimes even like minute to minute in tune. So what I do extensively is stay on top of that and monitor. So 2 things that really affect interest rates, and I'll try to keep this as simplified in layman terms as possible for the audience and stuff like that. But 2 things that really drive interest rates is mortgage bonds, which work off of something called mortgage-backed securities, and then the treasury yield, right? So those have been, and the media does such a phenomenal job of not educating consumers, right?
Yeah,
about that
absolutely.
Stuff. To create, whether it's intentional or not intentional, because it is sometimes very, very high level. Because even when many of the data points that we'll look at, which I'll talk about, usually comes out at like 8:30 in the morning, from inflation and employment and unemployment. So I'm sitting there, I would have finished my workout, walking the dog, and I read it, and it comes in, and then I'm like, wait, is this good or not? And I got to read it about 3 or 4 times to see, all right, well, what were some of the expectations previously into where it is now and what we have going on. But, it's also really tough to say, every consumer asks, well, what's your interest rates right now? That was actually, one of the gentlemen who says,
0 to 100.
Yeah. So, it's really tough to give a specific interest rate because every consumer's situation is unique, right? And we're going to cover specifically from the residential side. Commercial, it's a whole different ballgame because that comes down to, you know, your experience and have you done numerous properties and is it a DSCR loan, and then it comes into your credit scores and stuff like that. But to kind of cover a little bit more into this, covering into the residential side, you know, we look at usually, I always say we take a look at the client's credit score, their down payment, which actually recently has changed now. Sometimes if you actually put less of a down payment, you might actually get a better credit score. So
Really?
It's called LLPAs, loan level price adjustments. They changed. This is Fannie Mae, Freddie Mac for conventional. So I explain that to clients. So sometimes every consumer wants to go and put 20% down.
Yeah.
Right. And I say, well, dude, like, let me ask you why you want to put 20% down. Well, I want the best interest rate and I don't want to pay mortgage insurance. And I say, okay, well, the market right now, interest rates are higher than normal. They're not the highest that they've been, but they're higher than normal. You know, 2020, 2021, you know, you were doing this for a while. You came in right in there. And the rates were in the 3s and the 4s and sometimes the 2s. We kind of came back to a little bit more. Now where they're sitting is anywhere from 6.5 to, I would say, like 7.25, right? And then really deferring between if it's a conventional loan, FHA is more competitive. But the main things that I'm looking at, and I was mentioning this to Mike earlier, the two things that we're really watching is, specifically in terms of interest rates, is inflation, and then we're watching employment. And inflation is basically a fancy way of, holy crap, where's our money going, right? And you know, you guys are contractors, right, based on experience. So, and you worked in finance, so you guys kind of see that the cost of everything skyrocketed. From lumber to, I was mentioning, we go to Costco now. We're spending so much money. We're like, holy crap, where did everything go? And I don't watch this stuff. I'm the guy that just grabs the cart and throws it in there. My wife is the one that's like, holy crap, a thing of strawberries is $5, and I'm like, that doesn't seem like a lot, you know? Because we're the guys that are like, you know, we're going to a stadium and you're getting chicken fingers for like $20. But so those are the things. So it comes down to inflation and employment. And inflation has been the sticky part right now because, you know, obviously, without getting political, the Fed pumped all the money that they had to. They had no choice. People were losing their jobs and all that stuff. They probably did it for a little too long than they wanted, but, you know, this is something that came out of left field. In 2018, 2019, if you asked me if I was ever going to offer a client a 2% interest rate or a 3% interest rate, I would have said, get out of here. Mm-hmm. You know, if someone lied to you or, you know, whatever it is. So that definitely changed, and it's funny because we're constantly seeing the scary word of the recession being thrown around, right? So I tell people, you know, it's important for them to understand that in the last 6 or 7 recessions, the housing market did actually better than the current stage in 5 of those past 6 or 7 recessions, you know, because we're dealing with inventory concerns and stuff like that without getting into it. But so inflation's the stuff. So last week we had the updated inflation report, which comes out monthly, and it's always lagged for a month. So we're July 2023 right now. So we get the previous month plus a year. So we got June 2022 to essentially June 2023 inflation, and it's monitored monthly. So it's a little lagged, but it has been showing us that inflation is going down. You know, June 2022, I was mentioning to Mike, it was almost as high as 9.1%.
Yeah.
The Fed wants 2. So you're like, holy crap, you know, it's a big difference. It just came out last month, taking away energy and food prices, came in at 3. 3 sounds a lot closer to 2, right?
Yep.
So we're certainly making strides. So now that we've kind of figured out inflation, it's on a downward trend, whether the Fed likes it or not, and they want to come up with, you know, their crazy misleading reports that all of a sudden, you know, what drives me insane too is, you know, you're in the world of contracting. So if you design a table and it's 2 inches too big, you're screwed, right? It's not going to fit. It's not going to size right. Or if you have a countertop and it's 2 inches too big, what do you got to do? You got to fix it.
Yeah.
Better than 2 inches too small.
Yeah. Now the crazy part is these numbers that are coming out, the Fed or whoever it is, you know, without naming people, they're like, oh, you know what? Sorry, you know, we're actually wrong. We're just going to revise the report.
But don't they do that every single month?
Well, that's my point.
Without anybody else knowing.
Like, it almost like remember I was mentioning when I first started talking was we're monitoring this like on a second by second. So when something comes out, like 2 weeks ago, ADP came out and said 497,000 jobs were created, and we're expecting like 220. The rates literally went from, at that time, it was like in the 7s, and it was about to creep into the 8s. And I was like, holy crap. I'm like, well, I'm floating. I'm going to wait. I know the CPI report is coming out the following week, and it did. And then mortgage bonds jumped up almost 200 basis points.
Wow.
So I think it's definitely important whether you're a client, because this affects investors too. Because I always tell, because we'll do a lot of non-QM, which is your non-traditional mortgages that are very geared based off of the overnight borrowing rates for banks. And this affects those investors too. So if I'm offering an investor right now, our terms are pretty competitive with different investors, but we're like 8.125 to like 8.5 for a non-QM DSCR loan, which is really good comparative to, right now on an investment property, QM residential, you're at like 7.5, probably paying a point and a half, depending on your credit and stuff like that. So there's that, and then employment. So that's been the sticky part right now, because wherever I drive, all I see is help wanted, or people want to get hired and stuff like that. And I know Indeed, Monster, ZipRecruiter, and these large companies are saying that these massive companies are no longer contracting them that much, or there's not as many jobs being opened, or whatever the case may be. And then I mentioned earlier, I own a mortgage licensing school. So I'm definitely seeing a little bit less people applying to join the mortgage industry. It's actually realtors and other professionals who are trying to become loan officers. The jack of all trades is the master of none, as I always tell them when they first sign up. But that's kind of the two things. And I think that's going to be right now, employment is going to be the biggest driving force for rates. And we're going to get to a point where we're kind of at the peak. There's no way, whether they want to deny it or not, we're at the peak. It's going to be a matter of how quickly are interest rates going to diminish. I don't think they're ever going to be in the 2s and 3s unless we get another pandemic out of left field, right? I also don't think they're going to be in the 4s. Could be wrong. Whoever's watching this, don't hold this against it for me a year from now, right? But based on what I'm seeing, I think we'll probably see, whether it's the end of 2023, so hopefully in about 5-6 months, or into 2024, I think we'll certainly start seeing the days of the 5s. I'm seeing 5s right now. Like I had a VA buyer. They're working with a builder contractor, who I'm really not fans of, the builder lenders and builder contractors, no offense to them. But there's always these built-in incentives in there that just make no sense, where it's like, hey, we're going to give you a $15,000 credit, but we're going to crack you $20,000 here that you normally wouldn't get cracked. Again, no one, if you guys run your business, you guys are successful. We need you to build homes. But I gave 5.75 for a VA borrower. Locked yesterday. 5.75 interest rate. Wow. So it's definitely, I'm okay. I think he might need one. It's definitely on a case by case basis. But I tell people in the topic, and then I don't want to keep talking, but the two things that I always tell a client when I'm working with a client, I tell them, listen, let's forget about your rate being 7 or 6.5, because every average person, you put it in front of them, I want 6.5.
Of course.
And
why would you want higher?
Why would you want? Now, well, this is where I tell them why, not that you want it, but why it's a better sound choice is, I bring it down to your monthly payment and your cash to close. Those are the two things. And again, whether it's residential, investment to an extent, right? Because it comes down to your cap or your ROI. And I tell them this, I'm like, listen, you're at a 7%, your monthly payment is, let's say, 4 Gs, and your out-of-pocket cash to close is, say, $80,000. At a 6.5, your monthly payment is, let's say, $3,900, but your out-of-pocket cash to close is, I don't know, what did I say, 80 here? Let's say 90. Because there's a cost to get that rate. You're going to pay discount points to buy the rate, which is 1/100th of a point, just because 6.5 sounds better than 7. So, dude, cough up an extra $100 a month, save 10 Gs. Your break-even point, if you took 6.5 instead of 7 right now, is 100 months. $10,000 difference, 10 grand divided by 100 is 100 months. That is basically, I'm trying to do math real quick in my head, but that's basically a little over like 8 years, right? You're not keeping this mortgage for 8 years. You're likely going to refi it, whether it's next year, whether it's 2 years from now. It's going to be more than 24 months. Take the 7, keep the extra 10, call Joey or call Mike, let them come to the house and make some facelifts to the home. Use that 10 grand to pay them. And then when you refi next year, the same house that you just bought for 500 or 600, just that it's sitting in the market. And I'm sure you could elaborate more on local markets, piggybacking into that. But the house is going to appreciate. And in the last 80 years, home prices appreciated 73 of those 80 years, literally, statistically. And this is on a national level. 73 of the last 80 years, home prices went up in value by at least 0.1%, right?
Wow.
And 5 of the 7 that it did not crash was right when you started flipping after 2008. So maybe you started a bad trend. But
I
you
bought
know,
in 2009.
2009.
January 2009. That's when I closed.
So, but it was after 7, 8, 9, 10, 11, and I think 12, 5 years of depreciation, which we all knew was happening, the housing bubble.
Yeah.
So strip that away, dude. Out of the last 75 years, home prices only dropped 2 years. So does it make sense to buy homes and build generational wealth? Right. And then that's kind of that. So that's kind of my approach with a lot of clientele, right? Whether you're brand new or you're an avid investor, whatever the case may be, if you have money parked, if you're renting, there's not even a conversation. You're paying 100% interest or 7 or 8 or 9. But now the tricky part, and I'm sure you could segue this into the listings part, is kind of the part where we're trying to, wait for rates to drop to get these sellers to want to move and take it from there. So.
Thank you.
Yeah, that was
very insightful.
Yeah, that
Try
was
to keep it as simple as possible because it's so tough too. So I shoot, if some of you guys were friends on Instagram or Facebook, I shoot a video every morning, walking the dog, and I've got the nice office. I've got a nice media room and with the green screen, this and that. Takes me forever to customize the videos, and I'm the guy that I would hire a marketing person. He's like, "Oh, I'll get it for you in 2 days." No, bro, in 2 days, shit's gonna change.
Yeah.
Like I need this to come out now. Now I shoot them while I'm walking the dog, and I actually get more love and attraction.
You
from
get
that.
more
It's
views,
more
right?
authentic.
yeah, it's more raw.
More authentic. But going back to the point, I think that's the stuff that it's just about simplifying it, and then we educate it to our clients, to our investors, to our realtors, to our partners, and then it makes sense, and I think that's our job is, we're licensed professionals and we're supposed to take the complicated that the media does that they don't, and again, I'm not here, but they don't show the full picture. And also the full picture for one person is not the same as another person.
That's right.
If you're a FHA first time home buyer, subpar credit score, you're not going to get the same interest rate and terms or programs or accessibility or even programs, right? Condos nowadays, the majority don't lend FHA. Right. There's ways around it through you could do a spot approval or a single unit, but the average lender is not going to know what the hell that is in the first place. I don't even know if you guys, well, you probably know what it is, but a single unit spot.
I don't.
So, yeah, where you basically, the entire association is not approved, but you get just that specific unit, say unit B, specifically approved. So there's ways around it, but the point is, I think we just explain to clients, and that holds sellers back too. Because sellers, if you're in an urban area or whatever the case may be, statistically, the population of borrowers are going to lean towards the govy loans because they're less stringent qualifications and stuff like that. And I think that hopefully as the interest rates tick, people don't want to give up their rates. Yeah. And I think that that kind of piggybacks to that. So
Right.
Yeah, right now the rates being so high is undeniably holding a lot of people back from buying a home. And I think that's probably a mistake, Real estate, to me, it's the best damn place to put your money. I mean, preaching to the choir, right?
Right.
But you're going to leave it sitting in the bank? 3% inflation?
yeah.
I mean, that's what they say. They fudge those numbers any way they want, I think.
Yeah, and then banks are failing.
And
So,
banks
so then you're
keep
you're
your money before you
subjected to
know it.
losing your
Oh my
money,
gosh.
like what happened with
Yeah.
Signature
Yeah,
and
And you
Silicon.
can,
those
and you can. That can happen.
Yeah, 100%.
In this country today, it can happen. You leave it sitting in the bank, it loses value on a daily basis. You're going to go buy depreciating assets with it? No. How about the stock market? Be careful.
It's a
You
cra-
know, a
it's crazy.
stock can go to zero.
Yeah.
You know?
Oh yeah,
A
yeah. Your
house
company closed up.
is not going to go to zero. Never going to happen.
If it does, you still have a roof over your head.
You need a roof over your head, man. Either you're going to use it yourself or you're going to rent it out, you know? And like you said, over time, it'll appreciate. You bought in 2009. I bought my first house in 2010. I was 30. It was my first house. I bought it for $300K. It's worth $600. Now I renovated that whole house myself with my own hands. So I did it fairly affordably, but it's a beautiful little Cape Cod in a nice town with great schools. And don't get me wrong, I would list it at 600.
Yeah,
Probably get 660 for it right now. And that's 13 years, right? Like that's pretty good return on
that's
your
not
investment.
bad. I don't know what other investment you could do to basically double your money, right?
Right. Listen, if I didn't want to sell it, it's costing me $2,000 a month. I could get $4,000 a month for it if I rented it out,
Wow, not bad.
right?
Well, what's the alternative to owning a property? It's leasing a property,
You're paying somebody else's
paying
mortgage.
someone else.
definitely.
Yep, paying
Sure.
someone else's mortgage. And it uniquely, as far as investments are concerned, this is the one asset you can use. You can live in it.
Yeah.
Everybody else has got, they don't even know what they have in their mutual funds. They've got a 401k plan. If you ask them what's in it, they don't even know what's in it.
And you can't even pull it all out, too.
Yeah.
I run into
You'll
that
get
all the time.
penalized.
Yeah.
Yeah.
Well, forget about penalty. I run into clients all the time, right? They want to buy a house, and then I say, all right, where's your assets coming from? Oh, I got $80,000 in my 401k. And I'm like, well, did you find out how much you can pull out?
Yeah.
Because a lot of the times, whether it's I don't know if it's an employer rule or regulation or that institution themselves, sometimes they won't let them take out more than 40%.
If that,
30,
I was going to say
if that.
30.
It-
Yeah.
Right.
So I tell them, like, well, we better find out first before Mike wastes his time and drafts the contract, or you waste your time and draft the contract, if it's accessible to funds.
Yeah.
If it's not, then we got to pivot creatively and gift and this and that. So, yeah, but.
That's right. Yeah. So I want to get into a little bit, Gilbert. What you said you did finance, right? Prior to real estate. What exactly did you do in finance? Because I also came from a finance background as well. I was a Series 6.
Okay.
I had a Series 6, a life and health insurance license, New York and New Jersey. So what specifically did you do in finance prior?
It's some time ago. I started off at Merrill Lynch.
Okay.
I had Series 7,
Nice.
6, 63, and 3 for commodities.
Okay.
And I really wanted to get into currencies and commodities. That was I just had this idea that I knew something more than anyone else, and this was going to be my area. But it was a very small, closed shop. It literally was, if you didn't know someone, you could not get in. Very small community.
Right.
So I was eventually migrated out of retail brokerage into money management. Went from there to derivatives
Sure.
for some time. And then eventually I decided to move and change jobs. Went into transportation. And that was pretty successful, except COVID hit, and suddenly I lost a job in the middle of COVID, and then migrated into real estate. Yeah,
Okay. Wow.
yeah.
That's a very interesting, background.
Thank you.
It definitely gives you the competitive advantage too, because I'm sure you guys see it as realtors now more than ever, having that background on the finance world.
Yeah.
And I'm going to be biased on that from my side of the world, right? But I think it definitely gives you a little bit more insight to
Well,
the consumer from a
I
cost
think
analysis.
real estate is easy enough. To me, writing an offer is where my expertise kicks in, and
Sure.
I'm comfortable with the numbers. You're more comfortable with the numbers than I am, but I can write up a good offer, and that's a huge part of the deal. I mean, anyone can show properties, right?
Yeah.
You can look up the MLS and show up properties. I want a 4-bedroom. Yeah, you can show someone a 4-bedroom property, but how to win a deal?
Sure.
Yeah,
It's not always about the price; it's about the terms.
There's a lot of people out there who think they're going to get their real estate license and they're just going to go open up
Yeah.
some doors.
Yeah, yeah,
That's all I have to do. I'm just opening. You're bringing to the table your finance background.
right,
I'm bringing to the table a construction background.
right.
There's not a lot of agents out there who genuinely understand the product that they're selling
Mm-hmm.
in the way that I do. I have taken houses down to the foundation and built new construction with my own hands.
Right.
I understand the product that I'm selling. And so I bet that financial background, I would bet, is particularly helpful on the commercial real estate side.
Right,
In sort of relating to your clients
Mm-hmm.
and being of value to them.
Yeah, yeah. But if you're comfortable, it comes over.
Yeah.
So that's my strength
Yeah.
in talking to clients.
Yeah, you brought a good point too. Mike, you're a listing agent, so you probably appreciate this more than ever. Is how the offer is presented, right?
Right.
And that's a major point that I have with a lot of the different partners that I work with. Is it's not about Mike's got a listing for 600,000, right? First of all, Mike's not taking anything less than 600,000, guys. So unless it's been sitting on the market and you got nicks and knacks here and there, let's get that out of the way. But then you're going over, right? And I always try to tell myself I hate saying this market, the term of this market, because it's been like this,
Yes.
for since 2020, I would say February, March 2020, it's been competitive and annoying, and we're pivoting and we're doing what we got to do, but it's been like this. Have we had to pivot certain ways? Yeah, and that's why we're here, and that's why we're staying successful. But you brought a good point where a house of 600, if you're offering, let's say, I don't know, 680, right? First of all, Mike's like, that's a great offer, but POF, right? Where's your proof of funds?
Right.
100%.
You know what I mean? Can you cover it? You got an $80,000 gap you need to cover,
Right.
plus your 20% down or whatever your terms is and your closing costs. So that's something I tell clients all the time. So Mike, you get a 680, this, that, they got the POF or whatever. First of all, I don't know why people are going FHA and waiving the appraisal and then putting 80K. That doesn't make sense. But I definitely see some offers. Or you get like a 650, 14-day closing. POF is given for they're working with someone like me who's calling them and saying, yo, dude, what's up? I'm not a stadium lender, as I call them, right? I'm not spending my money on TV ads. We're putting our money where our mouth is and putting systems and implementations in place. We can close hyper quickly. I can guarantee you, I can guarantee you a mortgage commitment within 72 hours. Our client's ready to rock. Got a DU approval. I just shot it to you in your email, and we can close confidently.
Right.
Sold.
Mike's going to take 650 or 680. So you brought a good point on that stuff, because it, from the finance world, is what I try to explain to a lot of the clients. It's not about throwing all your money to it, right? As opposed to, being able to make the best deal, and then explaining to the clients, of the interest rate factors and stuff like that. It plays a massive impact too, because some of my clients, man, who bought in 2018, 2019, I was telling you, a cash out refi closing right now. He bought the house, it was like 2012, 2013. This guy took advantage of COVID in terms of non-payment. Didn't pay his mortgage. I think got about $67,000 or $68,000 of non-payment of mortgage. But listen, man, if we're being presented these options, bro, I'm taking advantage of it. So essentially $68,000 to FHA loans. So what FHA does is when you go into forbearance, they file essentially a lien, a partial claim mortgage. So we find it out. You know what I mean? There were some horror stories I dealt with where it wasn't found out till after. Then it's a title issue.
Yeah.
But essentially didn't pay it. His interest rate at the time I think was a 5.75. It's a multifamily, Jersey City. I think he bought it for maybe $250 or $260 at the time. The house is worth right now. What did it appraise at? I think it was like $510. So he essentially doubled, his stuff. His payment was not that far off from what he got. I had to still keep him in FHA, which kind of sucked because credit score wasn't the best. But didn't pay mortgage for 2 years.
Jeez.
He now skips, right? Skips or prepays, about a month and a half of his mortgage payment. His payment is now due September 1st.
Right.
And he's walking away free 2 months, and he's walking away with $120,000 of a cash out.
Wow.
Hello.
And you tell me that's not, generational wealth or situations. I have a multi in South Hackensack we bought in 2017. I bought it for $510. It's now worth easily $950. I mean, I was able to, I'm not gonna say steal it, but get a really, really good deal because it was my father-in-law's best friend. But if I take that property in 2 seconds, South Hackensack, 4 bedrooms, 3 bedrooms, finished basement, separate access. It's essentially an ADU, kitchen, the whole 9 yards. 2 bedrooms on each, 4, 3, and that easily sell it.
Offers in hand in 24 hours.
You know what I mean? So that's the stuff that when you were saying about those offers and putting those offers together and structuring them, 100%.
Right.
Yeah, and it's not, you hit on an important point for people to understand. It's not just about how much money you're offering.
Right.
Because there have been instances where I've advised my seller client to not take the highest offer because that wasn't the best offer.
Right.
There's a lot of dials and switches that can be adjusted.
Right.
You could get an offer that's way above ask, but it's full of contingencies.
Sure. Yeah.
There's nothing in there addressing appraisal concerns.
Right.
So if it doesn't appraise, and they're counting on that.
Well, they're
counting
waiving the appraisal, and they don't even understand what they're doing when they're waiving the appraisal.
It's
Well,
it's
see,
like,
if
it's
they're
like
wasting
30% of offers break down. There's a large percentage of offers don't go through, right? Because of
if you're
appraisal
not,
issues.
listen, I mean, I'm going to be completely honest. If you're not limiting your inspections, down to your mechanical, structural, and environmental,
Right.
if you're not waiving the appraisal, or at least in some instances throwing in an escalation clause, or some instances throwing a cap of, 20K shortage or 30K shortage, and you're doing super fast closings, I try to have my clients do at least a 50% EMD upfront. Now, when we're structuring these offers, the buyer's agent and me, we're having this conversation together
Right.
with the client.
Okay.
So when I tell them the over ask, nobody wants to pay $50,000 more. Oh, screw it, these guys are trying to take advantage of me.
Yeah.
No, bro, you want the house or not?
Yeah.
1, 2, you're paying rent. So we've all agreed you're paying 100% interest, and that same mortgage that you're paying is not the same, or that same rent that you're paying is not the same when you first moved in. So we got that part down. So now let's say you put an extra $50K, your mortgage payment goes up $150. How much is your rent? $2,500. All right, so let's break down $2,500 divided by 150. Are you going to do with what we're asking you to do, right? And I think sometimes we do that. Now, listen, do we win them all? No.
Right.
Some clients still won't listen to me. They're going to listen to their cousin Pepe, who bought a house 10 years ago and thinks he knows better, and then they're going to either be unfortunately lied to, or maybe there is a golden spoon that is out there that I haven't found. But that's definitely what I'm seeing is of having the success with is a lot of those terms that we were talking about.
Right.
Yeah, the appraisal is one of those dials. Inspections is another huge one of those dials. Right. If you're saying I'm limiting inspections to major structural, mechanical, environmental, and safety, that's more attractive than I'm inspecting everything.
Yeah.
And there's no limits whatsoever. And then you want to be more attractive than that? Listen, it's a newer home. I walk through it. I think everything's all right.
You waive it entirely.
I'm going to waive it entirely, but I want to do a tank sweep.
Yeah.
Or I want to do a sewer scope. Because those are two real big things, right?
Yes.
But,
Yeah.
you know, and then if that stuff's all right, okay, whatever. The thing upstairs is leaking a little bit. You know, $200 in plumbing, $200 in electric, you know, some power washing. I mean, come on, get the house, right?
Yeah, I think that's what's most important, you know, getting the house. And I've had for example, I'll give you a quick example. We had a house that we basically, is a flip, right? And we had it under contract at 405, okay? And we had multiple offers. The asking was around 375 initially. And, you know, we had it at 405, like I said, and we had probably around 7-8 offers, something like that. Now, this was about 3 or 4 months ago, okay? And so the downside is that offer, they were waiving everything except the inspection, right, was not being completely waived, just, you know.
Limited.
Yeah, limited inspection, and then the appraisal wasn't being waived either. You know, this is a FHA buyer, by the way.
Okay.
So with that said, appraisal finally came in, right? And then it also took a very, very long time to sort of negotiate the inspection, right? They came back to us with everything. They wanted everything done. Like whatever was on the inspection report, regardless of if it was cosmetic or not, which wasn't supposed to be included, they wanted everything done.
Yeah.
Everything, you know? And we're like, wait a minute, this is like $15,000, you know?
Yeah.
And so after that, they said, okay, give us the $15,000 off the 405. So that means we're down to 390. And then appraisal finally came in.
And it's short.
Yeah, and the appraisal came in at 350.
Oh.
The appraisal came in at 350. The reason it came in at 350 was because this was an attached home. Okay, and this is in East Orange.
Okay.
So there's not that many attached homes. Well, that have been sold recently, right? So we don't have the right comps.
Yeah.
And so we said, you know what? That's too much of a difference for us to make up, and also for them to make up as well, right? And so we said, no, goodbye. We'll find another buyer. We did find another buyer, and, you know, they asked for a few things here and there, nothing big. So, you know, we said, you know what? We'll fix it. You know, like even this morning, we're trying to get the CO still. So this morning.
Wait, East Orange is taking a long time for the CO? Holy crap.
Yeah. So finally, we were, so the contract date was today to close, right? So now they're dragging it. I hope we close Friday. So, you know, they're dragging it out as long as they could. We still haven't gotten the clear. Actually, no, I apologize. The closing was supposed to be yesterday, the 17th. We were supposed to get the clear to close today. We still haven't gotten it yet. So I'm now like, fuck, it's going to go into next week now.
Yeah.
Right? So it sucks, basically.
What did it appraise at?
This
is the second time around.
Yeah, so they didn't. I don't know if they got a new appraisal or whatever.
Probably. Right? I was actually just going to say. So another thing that I always tell the sellers or investors, make sure that if you take an FHA offer, whatever the house appraises for is stuck to the property for 6 months.
Yeah.
So even if you find a different buyer, the case number, which is like the social security number of the house for FHA, transfers to the next person. So that 350, I'm assuming your new offer is conventional.
No.
It's FHA?
It's FHA.
Oh, so you better find out. Unless they're covering the difference. Maybe they are covering the difference.
So the new offer is $357,500.
So they're covering the $7,500.
Yeah. So, you know, we're all around screwed compared to the first offer.
Compared to the first stuff. But I'm sure your cost of acquisition was there to relinquish the difference. But that's something I always tell people with FHA. So make sure that if the house appraises, and even if the deal falls through, that appraisal report. Now, if there's flags on an appraisal report, you know, it falls down again into either the seller's going to fix it in advance, or the seller can say, screw it, this doesn't take FHA offers, which is a little bit of a gray area, right? I mean, I see some of these listing agents will be like, no FHA, cash or conventional. It's a little bit of a gray, yay, nay, unless the house is a little beat up. Then it offers 203Ks and home styles and stuff, which I always used to do your 203K or home style, maybe 1 or 2 a month. Now I'm doing like 3 or 4. Wow. And listen, they're annoying products because it's just more hands in the cookie jar when I say it, right? So you got the inspector, you got the appraiser, you got this, but now, especially if it's FHA, now you got the contractor, and now you got the HUD consultant. There's more hands in the cookie jar. But guess what? The inventory right now is tight. And we know the sellers who are putting some of their homes are either trying to catch a wave, right, that they think is not going anywhere, but they're putting it out there. And some of the inventory out there is a little funky, that you're going to need a 203K.
As is.
Yeah. Or as is. And then, either an investor's going to buy it. But if an investor's buying it, your price is $300, he's offering $250, right, or $275. Or you thug it out with a first-time home buyer who's going to come in and make it pretty. So finding the right contractors who, first of all, know how to work 203Ks. I mean, I just closed one 3 weeks ago in Patterson. Contractor, love the dude, right? Love you, bro. But he's like, hey, man, when am I getting my first payment? And I'm like, first payment, bro, this just closed. Like, we still got to, package it, send it over, and my company, we underwrite, service, fund, the whole 9 yards. But, that takes time. It's not going to happen tomorrow.
Yeah.
And now more than ever, there's a lot of investor suspenses. So I was reading an article because I thought it was maybe it's me, but if something's funky, I don't want it. But these investors are like picking up, what's this $1,800 in a client's bank statement? And I'm like, fucking bank statement? Now I got to go back. Oh, it's his rent. Well, all right, can you get a letter after you closed from the client confirming? That never used to happen to me. Wow. So I was like, is this maybe a company ordeal? Now, mind you, I have only been with this company. In the years I've been in the business, it's the only company I've been with. Because I say this, it's not the company that makes our success. We make the success with the systems and the knowledge and the implementation. So then, of course, I think it was like a day later, I see Housing Wire comes out, and it was like the highest number of loans that can't be sold is now on a national level. Because, investors are subconscious, and if an underwriter missed something, they miss something, they're humans, or if something gets missed. So what is that going to tell you? Investors are going to get tighter, and your stadium lenders or your institutional local banks down the street, they're not taking that, buyer. If it's clean, they'll take it, and they'll give them a better rate. I'll be the first one to admit it. But the second it goes like this, nope, they don't want to kill it. And they won't kill it till the day of closing. You guys know. Or a week before closing. So that's definitely been a little bit of the challenges. But opportunity right now, it's awesome. And like what we were talking about before.
Fantastic.
So.
Yeah, so go ahead.
You were talking about with the rental loans, right?
Mm-hmm.
I just doing one recently and it fell through. How important, or is it a telltale, right, for the audience if you're working with a contractor that can't start the work until the bank funds the loan?
Well,
is it a telltale?
they're not supposed to be working on the home until you close.
The day of the close, we go out to Home Depot, start picking up the sheetrock.
Yeah, why not?
But what if they say they can't get started until you? The contractor says, I can't get started until you give me some funds.
Well, that's exactly what I was talking about. Yeah. No, it's not supposed to. That's the tricky part. I mean, you guys are contractors. Did you ever do a 203K loan?
Yeah, I done
You
a
did?
bunch. Yeah.
You're coughing up your money. Generally, the first 30 days, 45 days, and then you got to submit for your draws and your requests, and then depending also on what type of FHA, if it's a limited or a special.
So the people that I've worked with, so I've done a few for, say, like Freedom Mortgage.
Mm-hmm.
I forgot what the other ones were because there was like one here, one there, one
Sure.
here. So Freedom Mortgage, I did a few, and the way we've always structured it, well, also depends on the type, right? Like home style versus
That's what I'm saying. Yeah.
So, but for the most part, I've been able to get 50% of the material costs up front.
That's good.
Okay.
But that it takes about a month.
Well,
You
you can structure it.
yeah.
If the loan officer and the HUD consultant, everybody's in lockstep, you can get it structured so that the day you close on the property,
get it up
you
front.
get that check
Sure.
right up front, and you're ready to roll right
Mm-hmm.
away. So I've had that done a few times, and that way, because as you know, right, Mike, every contractor is living project to project. Okay.
Absolutely.
So there's never any extra money left over.
No.
Okay. Regardless of how many millions you're bringing in a year. That's just how it is, unfortunately.
No, I agree. I mean, one thing we do to like protecting the borrower, so we create the mortgage contingency reserve. So if it's a big job, usually you'll have 6 months. So like I say, you get the 30-day free, right, quote unquote, and then we essentially have a contingency reserve of 5 months. So the client doesn't have to pay a mortgage payment for essentially 6 months. And we know, talking Jersey, the Jersey market, 6 months you buy a house for $500, probably be worth like $520, right? It's like, and then you do the repairs, and then you might be at $6.
Yeah.
You know what I mean? And then I tell them, now we refi, now you're in the clear, and I think it's also too, once you're vetted as a contractor, like now that same contractor, we have another 203K. So I brought the same contractor because it's Passaic County. Now it's a breeze, because the tedious part is getting the contractor approved, the workflow, workers' comp insurance this guy didn't have.
I have workers' comp.
Yeah. Well, yeah, as you should. But there's stuff like that. But now that everything is finalized and done correctly, now the next flow of things becomes so much easier. And then you put them in touch with the same HUD consultant, then it's a breeze.
I think on the second, third, once you have the
Gets
hang
more
of it,
streamlined,
and you understand the process, and then slowly also you understand how to do your scope of work as well, right?
And how the bank likes it, because I know different scopes of works are so I give them a template, and I go, hey, listen, this is how we like it. If you have your own, whatever, you want to put your little cool logo in the corner, sure. But this is, how we like it. We want to split it by material, by labor, by cost, by foundation, demo, this, that, and then present it, and then getting the same consultant on the same page. Because I've had, them crashing. I've had the worst is like the contract. They don't use, most of the times, unfortunately, they're not using the contractor we know. It's a family friend who's never done a 203K before, is squeezing this in just because. Yeah. And then they don't get it in there, and then I'm getting killed, and by the other side for communications. But that's definitely been a very, very common product. The 203Ks, more 203Ks than home styles, but 203Ks. I just did actually recently my first VA rehab.
Oh wow!
I've never done a VA rehab.
Me neither.
That had to have been super easy.
Huh?
That had to have been super easy.
So it was. But it, like everything, it's got certain. Yeah, I mean, it's basically a 203K, but the max work that can be done is $50,000.
That's it.
And you can't do structural work. So now you're pivoting, with the buyer. So she wanted to go down in the basement. I'm like, you can't structure, So we had to do this, and then it was actually coincidentally in East Orange, and then this house has no stairs to get into. So they've literally got they put crates. So then I'm like, listen, the seller's got to take care of this.
Yeah.
You know what I mean? Because we can't do structure work, and we can't switch it to 203K because the buyer wants the VA 0% down. Mm-hmm. So I think it comes down to us understanding our products. Mm-hmm. So if I'm a loan officer and I say, yeah, don't worry about it, and then you come down to the day of the closing and you can't do it, and she's got to get in the house.
Right.
And then the appraiser is going to go and check and say, well, you need stairs and you can't do it because the VA, you just wasted money on your inspector, your appraiser, and stuff like that. And that is what I am seeing. And I don't want to keep talking, but I'm sure you guys can comment on that. That is what I'm seeing now more than ever, is deals under contract going through and then they're falling. Or I'm getting the phone call by the agent, or many times by a lot of the different attorneys, because they know I'll tell you. If I'll look at it and I'll be, no, deal doesn't work. Get a co-signer, get this, get that, because it's black and white. Your Freedom Mortgage, your Stadium Lender, or whatever the case may be, follow the same guidelines we all follow. We're Fannie Mae, Freddie Mac, your 45, 49, your 56 FHA. You know, if your credit is shot and I can't get a deal desk exception, you know, you're dead. So that's been that. But a lot of the ITIN loans has been something that's been coming around. I didn't realize there were that many people that had ITIN socials, I guess, or ITIN numbers until now. I get off ITIN loans, and now everybody wants to get a loan. You know what I mean?
Can you elaborate a little bit on that?
Yeah. So
What's
the
a
ITIN loan.
ITIN?
So ITIN is a what does it stand for? Identification.
Tax identification.
Identifying tax identification number.
Yeah.
And you know what's the craziest part is it essentially acts literally like a social. I mean, you can get credit, you can open credit cards. I mean, the person who I had, who actually didn't even realize he had an ITIN on him, which was my mistake, owned a business. Paying taxes and a decent amount of taxes, has an ITIN loan. So my processor is trying to do, we always do Social Security verification. She couldn't get it. Not found. And I'm like, bro, I'm looking at his tax return and I'm looking at his 1099 and it's right there. I'm like, you can't tell me this is not right. And you know, you guys see me, I'm a big guy. I got fat fingers. So I usually will, 1, 2, 3, I'll type in 4, 6, 7 and I'll mess up. And then she's like, oh, I think you messed up. And I'm like, no, bro, I'm looking at the 1099 and it matches. So I call the buyer. I'm like, let me ask you a question. I'm like, is this your number, right? Yeah. And I'm like, what the fuck is going on? Like, you can't figure this out. So what do? I go on Google and I type in, what does 93? It was the 933 number, which I should have probably caught. Yeah, which I should have probably caught, which bothered me more. But, we're banging out mortgage apps. And I looked at it, and it was an ITIN loan. So I'm like, geez. So I had to restructure the whole loan. But we have one. We do a 20% down, ITIN borrower, 50% debt to income. So it's basically conventional. And we got it done, But
So that ITIN is an individual or
Yeah.
as a corporation?
No, as an individual. No, LLCs are different. Those are EINs.
That's EIN.
Yeah, EINs. So those are EINs.
So why are they using an ITIN instead of an
They don't
SSN?
have a social security number, and it could be for multiple, I don't know, political asylum or DACA. Yeah, DACA's been a big one. Yeah.
Okay.
Yeah, DACA's been a big one. But it kind of goes to show you, I mean, I've been doing this for numerous years, and I'm coaching and I'm teaching, and I'm literally learning something new every single transaction. I mean, a different deal I had, we closed about 2 weeks ago. And I'll never forget, we took the app and I'm like, all right, offer got accepted. Make sure she told me she's receiving child support. So I'm like, make sure you give me the court support order. You can get that from the probation division, or I can call you. So my background came from running very successful law firms. So where the intricacies in putting the things in place and managing about 17 attorneys. So I was always like, all right, what do you got? All right, let's look at the books. Let's look at the Rolodex. Let's explain this, explain that. So I have the connections with probation, and she goes, oh, no, it's not court ordered. Which totally threw things off. So now my questions is going to be, do you pay or receive child support? Is it court mandated?
Yeah.
So the laundry list of questions just keeps getting longer. But yeah, so. Nice.
So with that being said, our time is actually up. That was pretty fast.
Wow.
I want to thank all of our guests and Abdel for educating us on mortgages. So I learned a lot of new things. I-10 and a couple of different other things. So want to thank you guys, Mike and Gilbert, as well, and of course Joe and Gherald back there. So thank you so much. Catch us again next week, Tuesday at 2. Thanks a lot, guys.